Hey folks, Scott Reinhardt here, and today is September 30th, Wednesday. It's the day after the first presidential debate. No comments on that, but I do want to comment on this recent New York Times report on President Trump's tax returns. So, based on this report, I want to kind of talk about, what can we learn from that report? What perspective can we give? And the thing I think we learned is that in that report, there's nothing definitive that says there's tax fraud going on or that there's anything illegal. What is definitive, though, is that President Trump is aggressive when it comes to taking tax deductions. And there's nothing inherently wrong with that. It's kind of like being aggressive with your investments. If you're aggressive, you're taking more risk and you might get more return. So he's banking on that when he will have more IRS scrutiny. He has a higher chance of being audited. When you're aggressive on your taxes, you have a higher chance of being audited and therefore a higher chance of paying penalties and interest down the road. On the other hand, he could be conservative when it comes to his taxes. He'll pay more taxes up front, but has a much lower chance of ever owing penalties. So he's just taking the chance that, hey, I'm going to be aggressive, not pay the taxes now, and then, if the IRS disagrees with me on something down the road, I'll pay the penalties then. It's an option for any business owner or really any tax filer. There's probably some things in there that the IRS is definitely going to take a look at. Apparently he's paying these consulting fees to his family members. I mean, his family members are definitely in business, so it's not like they couldn't command a pretty high consulting fee, but there's probably some rules around that the IRS is going to take a look at. But the main thing that President Trump is benefiting from is this concept of depreciation. And it's a concept I think we can learn from because it's one that a lot of you are probably taking advantage of as well. If you own a piece of real estate or a rental property, you get to depreciate that over time. And depreciation is this concept that every asset has a useful life, and every year we need to expense part of the value of that asset, and it is a non-cash expense. So that means that President Trump has millions and millions of dollars worth of real estate, and every year he gets to expense it on his tax return. But that doesn't mean that he's writing a check for that expense. So he doesn't have outflow of money going out, so he can have a pretty high cash income without having a high taxable income. So it's something that every business out there takes advantage of. When I was in corporate finance, we had a whole team of people that worked on depreciation only. It's just part of our tax code. It's a massive thing that all businesses take advantage of, not just President Trump. So I think the main issue that people are going to have that this might have brought to light for folks that aren't accountants and aren't CPAs and things like that is that we have this concept of depreciation and maybe people don't agree with it. So maybe our tax code is going to change down the road because of it. I think if anyone has major issues with the fact that he hasn't paid a lot of income tax recently, it has more to do with these rules in the tax code, not so much that he's doing anything illegal. Now, we haven't seen the tax returns themselves. We're relying on the New York Times reporting. It's possible that when those tax returns come out, maybe it's not as bad as what the New York Times is making it seem, or maybe it's even worse. We don't know. And we may never see those tax returns, so we'll just have to rely on the information we have. So just wanted to give you that perspective, kind of tell you what we can learn from that, and hope you have a good rest of your week, and we'll talk to you next time.